Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. We are about to go through a very important video. Understand if there are signs of a recession coming. I don't know if you've heard all the talking heads on TV, but it seems like one is guaranteed. But we're going to talk to Dan to see what he sees behind the numbers, behind the charts. How you doing, buddy?
I'm doing very well. How about you?
Oh, I'm doing great. I've been studying recessions a long time. I actually think we're kind of set up to have repeat 1981, 82. Which was a 17-month recession, worst since the Great Depression, only to be outdone by the Great Recession. So I'm a little nervous myself.
I don't agree it's going to be that bad.
Awesome. Convinced me otherwise.
Well, as I've always said, the 81, 82 was the end of a secular bear market.
Correct. Yep.
And the end of that recession started a secular bull market.
Okay.
Which lasted until 2001. 20 years.
Yes.
Including the 1987 crash, which was one of the worst crashes ever.
Yeah, on a numbers basis.
That was right. That was right in the middle of a secular bull market.
Mm-hmm.
We are in a secular bull market now. So a recession and a secular bull market, I don't have that. I put that in one of my newsletters one time. Maybe I'll do it next week again. But recessions in a secular bull market are usually short and shallow.
Okay. All right.
And the jobs number and the economy itself is kind of implying that too.
I would yes. But as you've said repeatedly, jobs are last.
Yes, jobs are the last. I'm going to show that. We'll talk about that again. Jobs are last. But by the way, I'm glad people that are watching this don't know this, but you asked to start a little early today, which I appreciate because I was kind of trying to figure out how to end this in time we're taking off for Miami.
Oh, good for you.
We're gonna go see a show with Jason Bonham.
Oh, okay.
You know who he is?
No idea.
You know who John Bonham is?
No.
If any of your listeners are out there on YouTube, write it in the notes at the bottom.
John Bonham?
John Bonham, Bonham. John Bonham. He died back in the 80s.
All right.
But his son, he was a drummer. His son, Jason Bonham, is also a drummer.
Okay.
John Bonham was the drummer for Led Zeppelin.
Ah, did not know that.
So Jason is following his father's footsteps, and he's going to do a whole concert of Led Zeppelin music.
Oh, nice. That's cool.
Good. So we're going over there. As soon as we finish this, we're going to leave and drive over there. Yeah. Anyway, we're going to talk about, do we have a recession coming?
Yeah.
Let me share my newsletter first.
Sure.
If anyone's interested, just send me a note to breakpointtrading@gmail.com, and I'll add you to the list. I just do this every week for myself mostly, but share it with friends and folks.
Mm-hmm. By the way, you're not sharing it if you think you are.
Oh, I'm sorry. How about that?
There you go.
Okay, there's the newsletter, breakpointtrading@gmail.com. And I'll send you this week's newsletter and you'll get them from now on. If you don't want to get it, just send me a note and I'll take you off. No big deal. So let's start with this. This is from
St. Louis Fed.
The St. Louis Fed site, which is a wealth of information.
Oh, if you ever wanted to go to one site to get just a gob of data, it's definitely Fred. Yep.
Yeah, there's a ton of stuff out there. This is the unemployment rate, and it shows all the recessions going back to 1948.
Yep.
So anything jump out at you with this?
Yeah, jobs, the unemployment rate hits the bottom right at the start of a recession.
Just before the recession. It starts coming up.
Yeah.
Starts rising.
Rising, yeah.
Just before a recession.
Yep.
This line right here is about, we're at 3.7. So this is about 3.5, I think, something like this.
Yeah. Okay.
But you can see each time just before the recession that the unemployment rate begins to rise before the recession starts.
Yeah.
And then it really takes off after the recession starts, but it starts coming up before the recession. So that's something to look at. Now, one of the things that I noticed, and we touched on it in the last session, was energy.
Okay.
Energy seems to be coming down.
Yeah, it's
Let's-
sub $78 or something. Yeah.
70, it's below 72.
Oh, geez, 72. My goodness.
Yeah. I just went to a seminar the other night. One of these things where they give you a free dinner if you come,
Yes.
try to sign you up.
Yeah.
So very nice dinner. Turns out they were trying to sell us oil leases.
Oh, oil leases.
They had a whole program of, how they find these oil oil rigs that have already started pumping or about to start pumping, and the big boys have already identified where the oil is. So it's basically, bulletproof. You're going to make money.
Mhm.
And the guy kept saying, yeah, with oil now at 130, 120, $130, it's a great time to be in it. And I said, well, excuse me, oil's at 72 and dropping like a rock.
Hmm.
He didn't like that. He didn't
No,
like that.
I would guess not. You ruined his story.
Yeah, ruined his story. I'm going to show you something about oil in a minute. But this is, again, this is the Fed rate. The blue line is the interest rate.
Yep, Fed funds. Yep.
Fed funds rate. Right now we're at 3.78.
Mm-hmm.
We are, but next week probably will be at 4.28.
Okay.
They'll raise another 50.
Mm-hmm.
That puts us here. You can see we're at 5.25 back just before the Great Recession.
Yep.
Here's the unemployment rate at the bottom. Like I talked about before, it starts to rise slightly just before the recession.
Mm-hmm.
But interestingly, it's when the Fed starts dropping rates that lead into the recession. So it's right after the Fed pivot
Mm-hmm.
that a recession starts.
Yeah.
So this one back here before the Great Recession, I think, is the most representative of what we're doing right now. It went up pretty steeply. It got all the way to 5.25, which is basically where they want to go this time.
Okay. Yeah.
Right. So we're right here.
5.25. Yep. Mm-hmm.
And then they just held it. They held it there for a year. What is that?
Yeah.
A year and maybe
3-4 months. Yeah.
Yeah. Maybe a year and a quarter. They held it at 5.25.
Yep.
And I think that's what the Fed wants to do this time.
Yeah, I would say so. Yes.
But as soon as there were hints of a recession coming, then they started dropping rates.
Okay.
And then the recession hit, and Lehman and all of that hit.
Right.
So that's kind of where we're at again right now.
Okay.
All right.
So what I hear you saying is the Fed's going to keep raising, and they will hold tight for next year, and they won't cut until sometime 24, I guess, 2024.
So there's the next rate hikes after December is February 1st,
March. Yep.
March, and then the next one's in May.
Right.
So if they do a quarter in each of those, that's another 75 on top of 428, and they're at 5.
Yep. That's where I think they're going. Right. Yes.
Little over 5.
Yep.
All right. So February, March, and May.
Yeah. I think February and March are I'm betting on quarters each.
Right.
Okay.
So I think that by March, and I think they'll probably do those March. They might get to the one in May. Yeah, maybe, but at that point, the economy is going to be signaling recession pretty heavily. Okay. All right. And
now what would that signal be? Because I would argue that if the market's signaling a recession now, is unemployment going to go up, or what are you saying?
Unemployment's part of it, yes.
Okay.
For the actual recession itself, yeah, unemployment, people will lose their jobs. Mm-hmm. Companies are already cutting.
Yep.
There's layoffs all over the place. And then margins will get hurt.
Yep.
Earnings will come down,
Yes. Earnings recession for sure. Yep.
right? All of that will lead into a recession.
Okay.
But
Do you think it's a fast kind of rollover, or do you think it's kind of a slow drip and the Fed's able to hold rates stable
I
all
think it
year?
will be. I think it will be slow. I think the economy actually is stronger than the Fed expected it to be.
I agree.
I think
Okay.
it's going to stay. I think it'll stay strong.
Yeah.
I think unemployment will probably start to creep up, but you can see where it is right now.
Yeah.
It's still way, way low. Look at the 2018 to 2020 period. This pink line is 4%.
Yeah. We're at 3.7.
We're at 3.7.
It doesn't, other than the COVID crash, unemployment doesn't spike, from 3.5 to 10% overnight. Usually, it's a slower bleed.
That's right, and you can see it back here in the 2008 financial crash right here. I mean, it never got below 4. Actually, it was down around 4.5. So we're not even up to the lowest point it was back then.
Well, for most of my adult life, 6% was considered full employment. It wasn't
Right.
until very recently that 4.5 was now the new full employment.
Right.
Yeah.
Exactly. So I think it will be a slow climb in unemployment, which will allow the Fed to get to their. I don't think they'll get to 5.25, but they'll get to 5.
Yeah, that's what I'm thinking too.
And then they'll hold it.
Yep.
But I think they probably won't be able to hold it as long as they would like to. I don't think they'll hold it for a year like they did back here.
Okay.
I think the talk of recession and the indications recession is coming and practically here will cause the Fed to start to roll over, and then the recession will start. And again, I think the economy is strong and will stay strong, and I think it'll be a short and shallow recession.
Okay. I like it.
All right. This one I showed in the last one. This is the 10-2. This is the yield curve. Whenever the yield curve inverts, a recession usually comes about 6 months later. All right, here's the yield curve inversion over here. And then this is the 2 minus the 3 month, which has been a very good predictor of recession. So this is 2008. This is before the COVID crash. We're sitting at 0.02 right now. So it's just about ready to drop under. And then you can see unemployment again down here. So let's talk about energy, because this is the one that I think is signaling that traders and the economy are positioning for a recession.
Okay.
So the next few charts are comparison charts where I can compare two things side by side. In this particular case, it's gasoline and oil.
Okay.
So this is a daily chart. You can see gas right here ever since June. It's just fallen off a cliff. And also oil since June. And just recently, the last week or so, it's accelerating to the downside.
Yep.
And if we look at a weekly chart, it's even more apparent. So here's the 200-week moving average down here. So gasoline, it dropped. This is a 1 week. Each one of these bars represents 1 week. So this is just last week.
Now, I'm curious, when I look at gas and oil, for me, and maybe this is wrong, but it's a better telltale of the world economy. Right?
Yeah.
Because I think the US could theoretically be strong, but if Europe and China are freaking in a recession, this is going to go down. And I think that's what it's telling me. What do you think?
No, I agree. It is definitely related to the whole world.
Okay.
But I think that gas and oil are an indicator of what's coming. And I think energy suffers during a recession.
I agree.
People will be driving less. There'll be, factories will start shutting down, laying off people. They won't be using as much. So the price of gas and price of oil will start to drop. And it's already started. I think it's already implying that a recession is at our doorstep.
Okay.
This is the consumer discretionary versus consumer staples.
Yeah, this is a big one to me. This is definitely consumers switching, right? Needs versus wants for me.
That's right. So consumer discretionary are things that you would like to buy,
Yeah, wants. Yep.
wants, like a new car or a new 80-inch
Yeah,
TV.
Jeff Bezos was telling us, hey, it's time to buckle down. Don't buy those things. Costco's telling us people are buying less jewelry and less big TVs.
Yep,
Consumers are definitely switching or conserving or whatever you want to call that.
right. And on the right-hand side is staples. Staples are things like deodorant and soap and toothpaste,
Yep.
which I hope even in a recession, people still buy those.
Yeah, it seems so. Yes. Yes.
Interestingly, the discretionary, and I talked about this. I'll actually jump down. Actually, I'm gonna jump back to my newsletter.
Okay.
I talked about this. I think I might have closed my newsletter.
Eh.
But I talked about this in the newsletter. I'll bring it up here this way. Down here, I actually said that discretionary is made up of these. These are the top 5 symbols in discretionary.
Yep. Amazon, Tesla, McDonald's.
Amazon's 20%, Tesla is 18%. So just these 2 names represent almost 40% of consumer discretionary.
Look at that.
Just those 2. And then it goes to McDonald's, Home Depot, and Lowe's, interestingly, are the next 2 in the top 5. Okay. But if we look at the top 5 in staples, it's not nearly as heavily weighted.
Right.
So now Procter & Gamble is 14%, Pepsi, Coca-Cola, Costco, and Walmart.
Interesting.
So the interesting thing is, let me show you Amazon versus Tesla. And the reason why discretionary is struggling so much right now, remember, these 2 represent 40% of consumer discretionary.
Yeah, Tesla is racing to its 200-day and Amazon's way below it.
Way below it. These are ugly charts.
Yeah.
So again, is this signaling a recession?
Yeah,
could be.
I think so.
People are already starting to pull back. Here's the discretionary with compared to Amazon. This will really bring it home how important these 2 names are. Right. Consumer discretionary. Okay. So you see discretionary is right at its 200 week. Amazon's below it. Here's discretionary versus Tesla.
Yeah. Right.
Again, discretionary right under its 200 week. Tesla is right on it. So even if we get a good CPI number on Tuesday, like we talked about in the last session, Tuesday is the most important day probably for the rest of the year.
I'd agree with that.
Even if we get a good CPI number, 7.3 or lower, these will all probably bounce and start heading higher. But you can see how far away Tesla is from its 40. This is its 50-day moving average is the black line.
Okay.
Actually, that's I'm sorry, that's a 200-day moving average, the black line.
Yeah, 40 week.
40 week, which is 200 days. Okay. You can see how far away it is from that. And even the consumer discretionary, how far away it is. So even if we get a bounce, we could easily bounce back up and touch the bottom of this, just like we've done before this year.
Okay. Yep.
But it might be short-lived, especially if the recession really starts to raise its ugly head and people start thinking about recession, which I think they already are. They're actually thinking more about recession now than inflation. Because I think everybody pretty much figures the Fed has inflation beat.
Yeah, I think there's a couple of things going on. I think there's a general appreciation that peak inflation is in, that 9.1 will be the high water mark.
Yeah.
I think there's a general impression that the Fed is serious. They're not kidding.
Right.
And I think the trend is intact, and we'll see on Tuesday if that stays true. But yeah, I think there's a general impression that the recession's right around the corner. The question is, will it be short and shallow, as you're putting out there, or will it be, a la 81, 82, long and not a lot of
Painful,
fun. Yeah,
painful.
painful. Yeah.
I don't know if you remember, but I mean, this goes back all the way till the springtime when we were doing these.
Yep.
And I said at that time, by the end of the year, the talk is not going to be about inflation anymore. It's going to be about recession.
Yeah, no, you were absolutely right. And folks, Dan has his own playlist on this channel. You can go back and watch hours of conversations of him and I looking at this. This is that's why playlists are there, because we have receipts. People can go back and look at them.
So I did one of these for 15-year
Oh,
mortgage versus 30-year mortgage,
I like it.
just for fun.
Mhm.
That's what it looks like. They look pretty much it's the same, but it looks like mortgage rates have dropped the last couple of
Mortgage
weeks.
rates went from 7.18 to 6.33, 4 weeks in a row down.
Right. Yep. And the 15 years of 5.67.
Oh, nice.
The
Yeah,
charts
the
look
question,
similar.
go ahead. Yeah, the question for me on interest rates is, will we get an average below 6% for the 30-year? I believe 6% is a psychological number. People
Yeah.
start thinking, "Oh, I got 5.9 instead of 7.4." I think that that might pull some people off the sidelines, but we'll see.
Right. Yeah. Um, Here's the dollar versus gold
Mm. Oh, wow.
inverse relationship.
Yeah, look at that.
The weekly chart right here. So the dollar dropped off a cliff,
Mhm.
sitting right on its 200-day moving average,
Yeah, 40-week. Yep.
black line.
Mhm.
And gold is sitting right under its 200-day moving average.
Oh, look at that. That's
So if these two continue that trend, then gold should scream higher and
Mhm.
the dollar will continue to drop. Now, this would be good for multinational
Sure. Yeah,
companies.
I mean, yeah, we've talked about, and my other Wall Street guy on Mondays talked about, I think he said 8%, right? Hit to earnings with the strong dollar. So if that reverses, then it'll be a wind at their backs versus a wind in their face.
Yeah, one of the things I put in my newsletter was a search in VectorVest that looks for high dividend payers, quality companies that pay good dividends.
Mm-hmm.
And we actually did a scan. Let's see if I can show that. It's all the way near the end from VectorVest. Yeah, it's a scan right here. Where in their article they talked about creating the scan. They went back to December 31st of 2021 and ran a test on the top 10 stocks from the blue chip dividend payers.
Yep.
Screen.
Mm-hmm.
These are the top 10. So I took this article and then I created this, recreated the screen.
I like
and
it.
actually shared the screen itself with all the readers.
What is MPC? I don't know what MPC is.
I don't know what that is.
Okay, cool. I'm glad.
A lot
I'm
of
not
these
the
are
only
energy. A lot of them are energy
Yeah,
companies, but you
definitely
can see what they did. This is up until Friday, basically. So if you just bought, equal shares of the top 10 on December 31st, you would have had a 21% gain at the end of the year.
Not bad.
And if you did some portfolio management, then it would be even better than that, because you certainly wouldn't keep
Right.
two of them that are giving you 21 and 25% losses. You certainly wouldn't still be in those.
Right. Okay.
So I thought that was interesting. And I went back and tested it even back beyond December 31st. And pretty consistently, these are blue chip dividend payers.
Okay.
So these are, big companies that pay good dividends, but they are also stable companies.
Right.
They're not companies that are going to go bankrupt or anything overnight.
Right.
And I went back and did it for a few more years beyond that. And it was pretty consistently showing between 15 and 20% per year.
Nice.
Just by identifying.
That's ex dividend, or that's just the stock price, or all
That's
inclusive?
just the stock price.
So the dividends are on top of those numbers.
Dividends are on top of that. That's right.
That's nice.
So December 31st. So I'm going to do this. I'm going to run this scan on December 31st this year.
Oh, okay.
Which is just a couple of weeks away.
Yeah.
And I'll share what names come up
Yeah, why
in
not?
that scan, and we can track it and see what it
Yeah,
looks like for the year.
yeah, I don't know if you know this, but yeah, one of my goals for the next 13 months, I actually start my goals on December 1st just to have some fun. So I'm not like everybody else on January 1st. I'm trying to put 50K into dividend stocks over
Okay.
the next 13 months. So this could be a scan that I use.
Yeah. Well, if you want to wait till the 31st, you can wait,
Yep.
or if you want me to
Yeah,
run it.
I've already put in a couple of stocks, which you know about, Blackstone and
Yeah.
JPM. But yeah,
Right.
I'm going very slowly, so I'm willing to wait till the 31st. I like it.
Okay. Cool. And then the last chart I had here was banks, regional versus big banks.
Oh, look at that. Oh,
This is a weekly view. Again, they dropped off a cliff last week.
mm.
See that
I
last
just I
red
think
bar?
Yeah, I just think that's the market going flat. They don't want to be surprised with the
Yeah, it could very
CPI.
well be.
Yeah.
If we get a good number on Tuesday, this could reverse and it
Oh,
should
in
be
a
a green
heartbeat.
one,
Yeah.
all the way back up again.
Very cool.
But if it doesn't, we get a
Yeah.
hotter number. But I think this banks also, might be signaling recession coming as well.
Yeah. Well, I mean, I obviously do a lot of work with banks. I think banks are getting tighter on credit.
Right.
They're still not paying any interest on bank, like savings accounts, right? So it's going to be a very interesting when banks come out and report their Q4 numbers because um, they're making a lot of money just stacking money away at the Fed. So
Yeah, and they're already showing increased debt loads from
mhm.
consumers for credit card debt.
Yep, they're writing.
Although
They have
although it's still
reserves.
not higher than pre-COVID levels.
Right. It's up on a percentage, but it's still not back to norm. Yeah, exactly.
Right.
Yeah.
Just out of curiosity, anything that you notice about these two charts? Any patterns that you notice in these charts?
Um, well, the black line or the 200-day moving average seems to be a magnet for both of them.
Yes. This is a weekly chart, remember? Yes.
Right. Right. Okay. Uh, that's it. That's all I see. What am I
See a
missing?
head and shoulders there?
Mm, not really. Oh yeah, I guess. Yeah.
Here's a left shoulder.
Left
It's
shoulder,
a head.
head.
It's a right
Yeah.
shoulder.
Yeah, I guess I see that.
Left
Yeah,
shoulder, head, right shoulder.
I can see that. Sure.
Neckline will be right down about here.
Okay.
If this were to break down, this is what about 57
Yeah.
to a high of 77. That's about 20 points.
Okay.
Then the target would be down around here, 37.
Mm. Okay.
But in order for it to break down, it basically would have to break below this 200-week moving average.
All right.
It'd have to go below that.
Yeah, it'll be interesting kind of tying all this together. I think what we had this year based on your scan was very much oil and energy.
Right.
I bet you banks or financials show up more this time, but we'll see.
It could be. Yeah. So, I mean, just looking at a lot of these charts lately, and I look at a lot of charts
Yeah, you
during the
do.
week.
Yeah.
I mean, I haven't been really seeing very many that look good lately.
Yeah.
They're all like just going sideways or starting to, creep down a little bit.
Well, I
But
think we're going
that
in.
could be waiting for the Tuesday number. Everything could change after Tuesday.
Could be. Well, it is going to be an exciting week. Do me a favor, flash your newsletter one more time, and we'll let you get out of here.
Sounds good.
There we go.
So
Breakpoint trading at gmail.com. Send him a note. He'll add you. If you don't like it anymore, send him a note. He'll take you off. This is something I look at each and every week. Dan, thank you so much.
you bet. Have a good weekend.
You too, bud.